All right, let's take a look at some concept questions and some basic calculations related to receivables. We're going to start up here at the first question. It says the journal entry to record a note received from a customer to replace an account receivable is what? Okay, so what we have to do here is we have to understand a couple of things. What is happening? Let's say we've got a note, so what are we going to do with that? What does that mean? And then what are we going to do with this account receivable? Well, the account receivable is being replaced. So initially, we when we set that account receivable up, we increased it with a debit. So our account receivable is going down and assets go down with a credit. Okay. So if we look at our answer choices, let's just see here. We only have one of our choices that is asking us to credit accounts receivable, and that's choice A. So I'm going to go ahead and I'm going to acknowledge that that is the correct answer. But the other side of this is that what we've done is we've reduced our accounts receivable, but we have also created a notes receivable in its place. A notes receivable is an asset. Assets go up with a debit, and so that's the kind of the proof, so to speak, that A is the correct answer. Let's look at the second one. It says under the direct write-off method of accounting for uncollectible accounts, bad debts expense or bad debt expense is debited, and then we have four choices. At the end of each accounting period, when a credit sale is past due, whenever a predetermined amount of credit sales have been made, and when an account is determined to be worthless. Okay, so what we're trying to get at here is each one of these things that you have A through D. These are all we're going to do something at the end of each accounting period. We're going to adjust our allowance for doubtful accounts if that's what we're using. But when we're talking about the direct write-off method, what we're talking about is, if you recall from the presentation, these are businesses that don't have very many sales on credit. So rather than go through a bunch of trouble to set up an allowance for doubtful accounts as a contra account to the accounts receivable, so that we can come up with some type of a net value that's realistic for our financial statements, what we're basically going to do is we're just going to say, okay, our receivables are kind of an insignificant asset for us. And so we're just going to leave that amount alone until we find out for sure that we're not going to be getting our money. Okay, so if we think about it that way, our correct answer is going to be D. Let's just look at some of these. At the end of each accounting period, this is referencing the allowance method and the adjusting entries that we need to make, whether we're using an analysis of accounts receivable or a percent of sales, whichever one. So that's going to be wrong. When a credit sale is past due, this is always an indicator that a receivable is in danger of not being collected, but that's only a first step. And then it says C, whenever a predetermined amount of credit sales have been made. And this is also somewhat of a reference to the allowance method. Choice C is, so it's wrong. So D is our correct answer. Let's look at the third one. It says the balance in allowance for doubtful accounts will directly impact the end of period adjustment for the bad debt expense when using which of the following methods? And we've got allowance method based on aging of receivables, the direct write-off method, accrual method, and the declining value method. Okay, so I want to tell you that a couple of these are not even methods, and we can eliminate them. The allowance method based on an aging of the receivables is a write-off method, as is the direct write-off method. However, the accrual method is not an actual write-off method, nor is the declining value method, at least not anything we've studied. So that leaves these two. So here's the thing. When we use the direct write-off method, we don't have an allowance for doubtful accounts. So we can eliminate that. Remember, we said that direct write-off method, our receivables are such an insignificant amount that we don't really feel the need to adjust them until such time we don't show a net amount using the direct write-off method. We do, however, with this allowance for doubtful accounts. And so when we have an allowance method based on some type of aging analysis, we would have an end of period adjustment. So A is our correct answer. All right, let's look at this next question here. It says, Fellows Corporation has determined that the $2,700 accounts receivable due from Andrew Stevens is uncollectible. Compare the journal entry that is required under the direct write-off method to the journal entry that is required using the allowance method. Okay, so let's do this. Let's have a direct write-off right here, and then let's put the allowance method over here. So with the direct write-off method, we're going to just go ahead and we're going to, let's see, it was for $2,700. So our debit is going to be to bad debt expense for $2,700. And our credit, let's see, who was this customer? A. Stevens. Okay, we're going to credit the subsidiary account for Andrew Stevens. Is that his name? Yeah. Under accounts receivable for $2,700. And then we're going to directly hit bad debt expense when we find out that the $2,700 receivable is uncollectible. Now, under the allowance method, we've already made our estimate of bad debt expense, and we've already hit this account. So we're not going to do it again. Instead, when we set up our estimate at the beginning of the period, we credited an account called Allowance for Doubtful Accounts for whatever figure, hopefully more than $2,700. So over here, we're going to take off some of that. Allowance for Doubtful Accounts is going to be $2,700. And then I want you to notice that under both methods, the credit is going to be the same. Okay, so there you go. All right, what's this last one here? Says at the end of the current year, accounts receivable has a balance of $550,000. Allowance for doubtful accounts has a credit balance of $5,500, and sales for the year total $2.5 million. An analysis of receivables estimates uncollectible receivables as $25,000. Determine the net realizable value of accounts receivable after adjustment. Hint, determine the amount of the adjusting entry for bad debt expense and the adjusted balance for allowance for doubtful accounts. Okay, well, I don't think that's a very good hint, quite honestly. I think that is a complete and total waste of time. That's not how I would do this. There's a lot of information here, and you don't need very much of it. But what I do want you to focus on are two numbers right here. Our accounts receivable has a balance of $550,000. However, we have estimated that $25,000 of that is not collectible. Well, let's look at the question. The question says to determine net realizable value. So all we have to do is subtract out our estimate of what is not going to be collectible. And if we do that, we come up with $525,000 net realizable value for accounts receivable. And that's all there is to it.